Hi, everybody. My name is Jackson Pineau. I'm the Director of Public Affairs here at Minneapolis Area Realtors, and I'm happy to give you your mid-year market download for the year of 2025. Most of what we're going to be talking about is year-to-date coverage of what's been happening in the Twin Cities housing market. But before then, let's go through and let you know about just a few events that are available for you to dig in a little bit deeper on the MAR website. But I want to make sure you're aware of them because they are coming up. And now that we don't do these on a monthly basis, I want to make sure that you know about them well ahead of time. The first of which is our member appreciation event on August 14th here at the MAR building in Edina. All are welcome. We want to make sure that you register ahead of time, but please come join us for a free lunch from some food trucks, some refreshing drinks. A bunch of fun stuff is happening in our parking lot that day. It's from noon to 2 p.m. Please feel free to join us there. For new members, whether you're watching this or you have some new colleagues in your office, we want to make sure that our new agents are aware of a happy hour specific to them that is being put on at La Donna Cerveza Brewery on August 20th in Minneapolis. If you are a new agent or you know a new agent, please come to this event. We'd love to have you build that network of like-minded professionals in the industry on August 20th. That event is from 2 to 4 p.m. Further down into the fall, we have a free realtor safety training, cybersecurity for realtors. It is a growing concern, I know, for a lot of people. This is part of, realtor safety focus towards the second half of the year. We want to make sure that you know that this is a free class available to you. And then finally, a course that is in often hot demand at home with diversity. This is an in-person at home with diversity class. It is 7 continuing education credits held first on October 2nd. More details on this event are here when you register for the class. So please make sure you are paying attention when this does come up for registration. It goes quickly. Want to make sure that you know that that is available for you as well. This class, any of the other events that I mentioned, they are all available here on the MAR website. Please make sure that you're familiar with our new website format. Want to make sure that you all know that there have been some changes and they are definitely helpful for you all. Let's dive into the joy that is the mid-year market download. And boy, have there been some changes that have happened so far this year, right? I know there's a lot, so we're going to walk through a quick outline and, of course, the goals that I want to make sure you guys walk away with. The outline here, we're going to talk through some recent showing trends because the showing times data that you have on a weekly basis, sometimes people don't see it. Want to make sure you see it here. We'll then dive into the Twin Cities housing market, those good old charts you know and love, and some new ones as well. We'll take a peek at housing affordability, namely homeownership, homeowners insurance premiums, and that landscape there, as well as the general economic landscape and some political changes that have happened at the federal level that we want to make sure you are adapting to. And then finally, we'll take a look at the MAR heat map, this new tool that I'm sure some of you have played around with, but I want to make sure that everybody is exposed to it here on our MAR website. The goals, as always, we want to make sure that you stay informed and we want to make sure that you share these insights, whether you are a broker sharing them with your agents, whether you're an agent sharing them with your clients. We want to make sure that this information goes far and wide. So, without any further ado, let's jump into some recent trends in showing activity, and there's no better place to start off with looking at our rolling weekly average charts of daily showing activity. It tells us a lot about the most reactive aspect of our market, which is whether or not people are showing up to showings. This is data that comes from Showing Time, and it will show us that we are kind of at about the peak, if you will, the last summer peak of the year traditionally. We are currently following that black line ending on June 13th, this past Sunday. That's our current year, and you can see we're just slightly above the navy blue line of 2024, and we are below that 5-year average in a light blue. A lot of these charts are going to be referencing last year as well as a reference point. In this case, 5-year average, right? And you can see we're slightly better than we were this time last year. And if the 5-year trend is an indicator of where things are going to go, we're going to start seeing less and less daily showing activity on average as the season gets to that close, right? This is the last end of that peak of seasonality that we are all kind of aware of. Get ready for that summer framework to change as we get into that next dip that is Labor Day. I'll get my little laser pointer here. Labor Day dip happens just a couple months away. Dividing our showing activity by price ranges gives us a good insight of at least one way of viewing where people are showing up the most, right? And you can see some of these price points are getting a little bit more activity relative to last year than others. Overall, showing activity is up about 4%, 24,000 showings last week compared to the same week last year. And in some parts of the market, namely 6 to 800,000, 4 to 500,000, we're up almost 20%, in some cases 20%. That's a noticeable increase in, let's call that the higher market rate end of our real estate market. The top dog, so to speak, for this week is the million plus category, that luxury category with a 30% increase. Keep in mind, little grain of salt here from your stats nerd. We're up a 30% increase, but it is by far one of the smaller price categories. So it's more likely to see those large percentage increases. As impressive here is the $400,000 to $500,000 range, increasing up 17.5%. Take note here that our largest area of $300,000 to $400,000 homes took a bit of a decline this year compared to the same time last year, following suit with some of the more affordable price points in the category. We are seeing fewer and fewer of these appear over time as the dollar ends up becoming more inflated, plus the inventory of homes end up, if someone can find a home for under $200,000, they probably end up buying it very quickly if that's the home that fits them, right? Very few of these in the market relative to the $300,000 and $400,000 range, right? Change in showings year over year is dependent on one thing in particular, many things, but one predominant factor. How far can your money stretch when you are looking to buy the home you are walking through? And when we see fixed rate mortgage, FRM, here in teal, go down, we see an increase in showings year over year. And that is the trend we are seeing right at about nationwide metrics for a 30-year fixed rate mortgage. When that is about seven, let's say just under seven, we start seeing general increases. And you can see this widening of a gap between the navy blue line in change of showings and fixed rate mortgage in teal. They are separating. But if we see a rebound in the teal, increasing back up high above this 7%, we will see a decrease of showing activity again. So keep that in mind. The quick and dirty version of why aren't fixed rate mortgages going down is explained kind of in the inverse relationship of this chart right here. But don't worry, we'll get into more detail with that in a minute. But before that, let's take a look at those local housing market charts that we all know and love. And because we are halfway through the year, I feel obligated to give you the perspective of year to date comparisons because It is such a natural inclination while we are in the midsummer months. We've seen 6 months of activity in real estate here in the Twin Cities. We should compare, we should use that reference point year to date rather than just the month to month. Don't worry, we're still going to bring in the month to month, giving you the most finely tuned data possible. But let's start off looking at closed sales from a year to date perspective, taking in all closed sales from the first of the year until the last day in June. And we ended the first 6 months with just short of 16,700 homes closed in that 6 month period. That is pretty much on par with what we were at in the first half of 2024 and an increase from 23, but not quite where we were at in the height of 21 at 22,000, let's say, and certainly not where we were at in, let's call them the pre-pandemic years highlighted here in 2018, 19, and 2020 at just short of 20,000, right? We're about 3,000-ish short of that. And in all fairness, we know that this is the first half of the year and that we tend to have a seasonal curve, right? We have lower activity in February, March, but more activity in April, May, June, and then it tends to fade off as we were seeing with showing activity in the first chart, right? That green line shows you that seasonal arc. So, in all fairness to that seasonality, let's take a look at the year to year comparisons just for the month of June, highlighted here, comparing navy blue for 2025 June and teal for June of 2024. We're up 7.5%. Now, that is a notable increase in year over year comparisons of closed sales comparing May, which is basically flat, up 1.5%. Same thing, April of 25 compared to April of 24, up only about 1.5%. But June separated in a meaningful way, right? We were starting to see a positive growth out of last year's metrics, at least in closed sales. But the ominous reference point that I alluded to earlier in this green bar shows us the 10-year average of closed sales for each respective month. And you can see we are notably below about, let's say, 1,300 units of closed sales for June, below where we are at currently with about 5,000 homes closed last month. Shifting over to the new listing side of the conversation, supply to closed sales demand, you can see we ended the first half of 2025 with just short of 29,000 homes listed on the marketplace. That's up about 4.5% from where we were this time last year in the first half of 2024. And again, an increase of 15% from that of a relative low point of supply in 2023. We're again not quite back up for where we were in 2018, 19, right? But we are growing out of this reluctance for homeowners to list their home on the marketplace, right? This is a positive sign that we are returning back to that equilibrium. Although you can see when we look at that seasonal chart that shows us just for the month of June, just for the month of May, just for the month of April, we again are under that 10-year average trend, right? Only a 0.5% increase or so above where we were June of 24 compared to June of 25. A similar trend of what we were seeing in May, but April was really the month where sellers decided, hey, let's give this a shot for the spring and summer and list our home, right? Now, some takeaways that I want you to see in this, right? From the buyer's perspective, there are more listings, right? We are seeing that seasonal growth, not only the seasonal growth, but the year-to-date growth coming out of 23, 24, and now back into a 4% increase in 25. More listings means more options for you as a buyer, right? And that competition is relatively flat, right? So we are likely to see that competition grow over time. And that is a relatively good mixture right now, right? At least in terms of just pure demand versus supply. This is a good situation for the buyer's perspective, right? Watch those mortgage rates as we were seeing with showing activity, because that's really going to be your indicator if they are continuing to be reluctant uh, to drop into the mid sixes. You know, take more consideration, but be paying attention to those interest rates because they are sensitive to what's going on in the larger market rather than just here in the residential one, right? Sellers, demand is stable. We were seeing marginal gains in demand, but it is still relatively stable, stable enough for many people who are deciding to list their home in 25, much more than what we were seeing in 23 or even in 24, right? So with that demand, uh, there is that promising buyer activity that we saw just in the month of June, potentially in the month of July as well. But keep in mind, summer market is fading, like we were seeing with showing activity. We will need additional support selling agents for those clients as we get into the summer and fall months. They might be a little bit more anxious than they otherwise would be because they've seen 2022, they've seen 2023, and then the drop off in 2024, and now a kind of a rebound in 2025. There's a little bit more anxiety than there otherwise would be. They're going to need your support in that regard, right? Let's take a look over at median sales price and talk about a big ticket item that I think many people are going to be paying attention to. Not necessarily in this chart, but in the next one. Just to set the scene here, we know median sales price is meant to grow over time, right? That's the whole point of why we get into this business is to achieve long-term financial gains from the value of property, right? And at the median, so far this year, we have seen the median of homes sold in the first half of 2025 reach $387,000, up 3% from where we were this time last year. And you can see a very intricate, let me get my drawing up here, right? We're gonna get a little pen going. There are kind of two situations that are happening, right? There's a steeper increase happening from 2018 to 2022. That was because interest rates dropped, right? And then when the Federal Reserve decreased or in they uh, increased their interest rates, therefore increasing the interest rates of mortgages, right? We started seeing prices decline, right? There's an interesting thing happening here, and I want to bring our attention to it, right? But keep note of that change that was happening, right? That's a very intentional thing that happened in the entire economy, not just in the housing market. But the main talking point right here is $400,000. For the first time in the history since we've been recording this, the median sales price in the Twin Cities is over $400,000. And that is going to be a sticker shock in some degree. It is mostly symbolic. We have been hovering just short of $400,000 for a while now. And in fact, if you look at the archives, April also was at 400,000. We just didn't quite know it. We didn't have all the data at the time. When we pull this data 5 days into the month, sometimes reporting in the MLS comes a little bit later, right? So we are in a world where the Twin Cities median price home is 400,000. And because that number has ticked over to the next unit of hundred thousands, there's probably going to be some people paying attention to that. There'll probably be some demand cooling in some degree because the absolute value of a home is one unit larger than they thought it was going to be, at least at the median here. Now, a keen eye, you will see 3.5% growth over 20-year average is that little green tic tac that I'm highlighting with the red laser right here. And if we were seeing price growth above 2.8% for the month of June. You would see the blue bar reach up to that green mark, right? Similar to what you were seeing here in April with 3.7% increase in price growth, a little bit higher than the green tic tac, right? This is an indicator to me that, on average, with that 20-year average price growth, we might have achieved this, symbolic shift into the 400,000s sooner had we not seen that decreasing of median sales price like I just drew out for you in the last slide. Why do we have some reason to believe this, right? Taking a look away from the Twin Cities here and looking at Fannie Mae home price expectations, you can see at the beginning of 2025 or the end of 2024 in this instance, that there were some pretty optimistic and pessimistic ways in which home prices were going to grow. Ignore the horizontal vertex here. It's an index, and we're talking about percent changes based off of the cumulative home price of that index. It's distracting. The important part here is that for 2024, the panelists' average home price growth expectations was going to be around 5%. And in some months, we are seeing that. In others, not necessarily, right? So, what's happening here in the Twin Cities? Taking away the absolute numbers of median sales price and just looking at the year over year change in median sales price, you can see that there were three different environments, much like a lot of these charts here, right? There was the pre-pandemic years that were somewhere around, let's say, 6 to 8% growth year over year for every single month, right? And then in the lime green here, the COVID phase, and really like the most active period in which we had unsustainable increase in inflation. I know there's a different argument of when COVID ends, but for that highlighted green area, you can see a meaningful difference in year over year change in median sales price, right? And then once the Federal Reserve, you know, turned their lever and they were able to disincentivize, the rate at which we were taking out loans, all of a sudden change in median sales price started to decrease. We, in fact, saw 2 months where there were negative price growth, right? But only two. And believe me, we were lucky compared to many other metro areas. Since then, we've been seeing much more conservative price growth. And that's quite literally the line that I crudely drew for you 2 charts ago, right? And this is noticeably lower, somewhere between the high twos to high 4%, except for like one outlier here, than the blue area off to the left, right? So, what does this mean in terms of the expectation of reaching $400,000 at the median sales price? I did the math out for you. Fairly basic estimation here, kind of a back of the napkin sort of way of doing this math, but extrapolated out, assuming a minimum alternative here in orange or a maximum alternative of if COVID didn't happen, if the unsustainable inflation in response to COVID didn't happen, where maybe would there be the bounds of our price growth on a month to month basis? And my best guess here is that we would have reached that $400,000 median sales price threshold sometime in 2024. So, in some ways of looking at it, the correction in 2022, really since 2022, when the Federal Reserve made those changes to their own savings rate, that stalled the increase of over 400,000 median sales price by about 6 months. A necessary evil from some perspectives, because some people absolutely want price growth. From the buyer's perspective around housing affordability, it's still a concern to see this number be reached, right? But this shows me, at least novel, from a novel perspective, that probably would have reached there anyway, right? Okay. Enough about $400,000. You guys have more than enough to be able to talk to your clients about that if they're concerned about that sort of thing, either from the seller's or the buyer's perspective, right? Let's take a look at average percent of list price received in terms of a year-to-date context. And there's, again, three distinct worlds that are happening here, right? Negotiations generally existed in some form, although maybe some of them were few and far between. Again, this is at the average, not at the median. Um, in 2018, 19, and 2020 for the first half of their respective years. And then for the first half of 21 and 22, negotiations did not exist, right? In fact, here at an average for 2022, the average home was getting 2.5% over listing price for the first half of the year. We know stories of people getting well over 2% over original listing price, right? We are now back to a world of negotiations where at least they're part of the conversation, right? We see that for the first half of 2025, a very satisfying 98.98% of homes of homes that closed, they received on average 98.98% of their original list price. Um, and that is about where we have been for the past couple of years, right? From a seasonal perspective, again, these are looking just at the respective months. June looked to be a year last year where we saw slightly over asking price. That competition was there, and still pretty much the same case. We are seeing 100% of a list price received in June of this year. Again, you're seeing a difference of 0 and 0. It's down to the rounding of this rather than going 3 or 4 decimals past for you. There hasn't been much change in May, little change in June, little change in April. But the big thing to note here, look at where we were at, the impact of a 10-year average. Again, we are seeing the influence of COVID in particular for 3 of those past 10 years, right? The takeaways in terms of prices and negotiation. Price growth slowed down intentionally. It's something to communicate to your buyers, right? Something that I think is really important to acknowledge is because price growth is part of the game here, right? Whenever someone chooses to buy, whether it's the first time or a returning buyer, they're buying ideally at a time where prices are the highest, right? But the long-term investment, you're catching it now, so that way you can benefit from that price growth over time, right? Now, a more uh, eloquent way of capturing the uniqueness of this low sloped growth right here that you are seeing for the past couple of years means that the alternate reality is that this more steep slope could have existed and in the long run probably will catch up. That's called a great mean reversion. Maybe we'll show that next time. But that means that if you're buying a home at a point in time where price growth is marginally less and you close and you stay in that home enough for that catch up to occur, you're going to be the one benefiting out on that, right? So price is high, yes, but negotiations are back. This could be a good time for you if you are financially ready to buy. Don't wait to buy. Those prices will pick back up, right? Seller's perspective. Same statement, different sentiment. Negotiations are back, right? And while there is a symbolic and expected change in the median sales price of over $400,000, which again, I'm assuming will probably be in the public mind when we release this publicly in later this week on Thursday, in fact. Um, that is something that I want to make sure that you are ready to set those expectations about price, about offers for sellers, and make sure that they're prepared to understand the reality of the world that they're in. And one of those realities is often asking the question, how long is it going to take for me to sell my home? Enter in median cumulative days on market. For the first half of this year, half of all homes sold in under 25 days, a little bit slower than the first half of 24, and pretty much on par with about what we were seeing in 2019. And I could see this as a indicator that we have returned back to at least a pace that is similar to where we were pre-pandemic. We're always looking for those indicators of when does the volatility end? When does the, instability in the marketplace end? This is one of those indicators for me that's showing us that we're at that new normal finally. We were kind of talking about the new normal in 2021. This is kind of that new normal, at least in terms of median cumulative days on market. Let's take a look at the month to month comparison here, looking at both April, May, and June. Another great indicator that we have found a new equilibrium. We are steady Eddie. We have seen a 0% change for those last 3 months, even with an increase in seasonality. And in fact, looking at the 10-year average, yes, we are a little bit lower than where that 10-year average is in June, but we are fairly close to it. I don't think it's a meaningful difference given how consistent the rest of this data is showing in terms of pace. This is a promising sign that there's stability in the marketplace in terms of pace. But let's talk about month supply of inventory, right? Because at this scale, you can pretty much see the same sort of story, right? Higher on the left, higher on the right, less in the middle, right? And you'd be forgiven to think that this is the context that we're working in because you are right to a certain degree. 2 months supply of inventory, or 2.2 months supply of inventory, for the first half of 2025, which means at the rate at which people were buying homes, if there was no more supply of homes into the market, the 6 month supply of inventory would be gone in 2 months at that current demand rate, right? And it's a little bit slower than it was in 24 and noticeably, doubled than where it was in 2021. We're back to where we were around 2019, 2020, that sort of area. A good indicator, right? And similar things, what you're seeing here relative to the 10-year average. Again, we're looking at an individual month of June here, not just the first half, right? And you can see barely any change from June of last year to June of this year, or a bit of a change from May of last year to May of this year, a bit of a change from April last year, April this year. But we are all in and about around the 10-year average, slightly slower than that for each of these respective months. And I bring in this caution here to talk about the larger scale. I make a point to really just kind of focus in on the last 8 years with a lot of these charts, but with this one in particular, it's worth getting the full 2 decades almost worth of context here of month supply of inventory. Just because we have doubled from 1 to 2 month supply of inventory does not a balanced market make. 4 months supply of inventory is the threshold that we would normally define as the minimum amount of inventory you would need in order to keep pace with that demand. Anywhere between 4 to 6 months supply is considered a balanced market. And we haven't experienced that since 2014, really. Now, someone brought this up to me at a previous presentation and said, Jackson, I've been working in the business for 20 years and I I gotta admit, like from my perspective, I've seen 2008, I've seen 2010. I get that that was a buyer's market, but this feels more like a balanced market to me. Why are you telling me 4 months supply of inventory? And I said, you know what? That's a fair point. I've only been working here for a quarter of the time that he had been practicing real estate. And so who am I to say, hey, with the experience that I have, right? The reality of it is I haven't experienced it. You with 15, 20 or more years worth of experience haven't experienced it. The reality is none of us have. because you're talking about what's called a missing counterfactual. You're counting on a reality that's happening based off of what an equilibrium could look like, but isn't ever realized. And I think a great way to put this into context is this chart here, talking about the actual inventory shortage. And I don't have year-to-date measurements on this. This is something we kind of build more in an advocacy lens to talk to local elected officials about what does the housing shortage look like in their city, right? Just for the month of June. These are just June numbers for June 25, 24, 23, and so on, right? You can see for the Twin Cities overall, if there are 9,800 homes that are, I think in this case, this is pending sales. So there are signed contracts for in June, there needs to be another 13,500 in order to get the balanced market that we would be looking for in a true sense of a balanced market. And we've been experiencing this, not only for the 10 years that you see on this chart, but we've been experiencing this really, since 2012 in most cases. It's month after month, year after year of undersupplied marketplace that's driving a lot of this that we're talking about, right? It's not just on a month to month basis, looking at it in terms of different property types. Some are treated different than others. In this case here, for the most recent month of June, about 80% of the condos that we would need for a balanced market are currently being supplied on the marketplace. And 45% of the townhomes that we would need for a balanced market are currently being supplied. But only 38% of the single family homes that we would need for a balanced market are currently being supplied. 10,000, almost 11,000 single family homes short just for the month of June, right? This is one of those reasons why that even though housing prices are high, mortgage rates are high, and there is a general, a decrease in buyer activity. There's a softening in buyer activity. We're still seeing after that initial reaction in 2023, this is the share or the percentage of all sales that are single family homes for the first half of this year. We're starting to increase back up to the rates that we were seeing in 2019, right? 73% of all homes sold so far this year are single family homes. And of course, the inverse of that is townhouse and condos, or townhomes and condos, right? We saw an increase when all of a sudden our dollars couldn't stretch as far in 2023, but there's been a lessening of that ever since. And that's because the demand is needed in those property types. Now, it's not just property types we're looking at. We're looking at a shortage that varies across different price points as well. We have a lot of the demand that is being met for those more affordably priced homes and definitely for the luxury priced homes. But those market rate homes of 3 to 500,000, there's a gap there, right? That is what we're talking about in the advocacy space when we talk to you guys about the importance of, advocating for home ownership policies that benefit us. It's because we're seeing statistically that there's huge shortages that are happening in the marketplace. You guys know this, right? But so let's divide. Let's come back and take a look at marketplace and inventory, the takeaways for that, right? For the buyer's perspective, slower market means more time to prepare to make the right move, not all the time in the world, right? And keep in mind, like what we were just looking at in that shortage template, not all homes are equal. Gems sell quickly. The right priced home sells quickly. If you are looking for that home at that market rate, there might be more competition for your client than at a more premium price point or at a more affordable price point, right? Sellers, I understand that, from a certain perspective of just the past couple of years, that we've seen a doubling of our absorption rate of our month supply of inventory. But we're still in a strong seller's market. Listings will not languish on the market. In fact, we were just looking at a pace of half of all homes being sold within a month, right? That's a reasonable expectation, even though it's noticeably different from where we were at in 22, right? So, closing the chapter on that, let's take a look at housing affordability with the 10, 15 minutes or so that we have left, right? Monthly payment trends are a big portion of that. So we're going to look at PITI, principal, interest, taxes, and insurance for the median priced home. We did the math out here for you. So assuming a certain percent down, a certain interest rate, we have the median priced home estimated to be at least the end of this year, or the end of 2024 being about 2,800, and most likely we're around the $3,000 mark here for the median priced home here in the Twin Cities. The silver lining in all of that is that the median family income here in the Twin Cities is higher than most other metro areas relative to the cost of living. We know that because we can take the median family income, and we can divide the median sales price of a home at about, we were saying, what, 380, $400,000. And we can divide it by that MFI to get roughly a 3-to-1 ratio of the payment to income for a home. So we got two measurements here, payment to income and monthly payments, right? Comparing the Twin Cities region to others, we're doing okay in terms of that silver lining of price to income ratio. We have relatively affordable cost of home ownership relative to the earnings that we are seeing here in the Twin Cities. We're about middle of the road in terms of monthly payments from a absolute value perspective. We are not necessarily Pittsburgh, Detroit, Indianapolis. We are closer to that of Phoenix, Salt Lake City, Charlotte, that sort of thing. Um, but I said that I would talk about homeowners insurance, and boy, have we heard about homeowners insurance, right? We know that there have been an increase in insurance premiums. Our good friends at the Federal Reserve of St. Louis pulled some Bureau of Labor statistics for us to show nationwide we averaged about 1.5% increase in the producer price for casualty insurance premiums of homeowners insurance uh, over a pretty stable period after 2020, right? And then in 2023, we started seeing a dramatic increase, up 11%, now hovering somewhere around 9%. And the Federal Reserve of Minneapolis also backed up these claims, saying that yes, over a period of 2017 to 2023, Minnesota overall has seen homeowners insurance premiums increase 39% from 2017 to their values found in 2023 on average, right? Now, something that I have mentioned before that I want to just make sure is caught for everybody here. We know that we can't find the premiums themselves, and I have, since the last time I chatted with you all, talked with someone who's able to give me a little bit of a download. But we do know that homeowners insurance doubly affects condo owners, right? Their HO6s for their units, and then their master's insurance policy is paid for by their HOA fees. Luckily enough, you all in North Star put in your HOA fees in your listings, and we can use this as a proxy for a measurement of monthly HOA fees, kind of a proxy for premiums in so many ways that increased somewhere here in 2023, about the same time as Fred saw the increase in premiums. And lo and behold, if you take here in green the year over year change in HOA fees at a rolling monthly average and compare that to the year over year rolling monthly average of a median sales price growth, you can see condos in particular here are seeing their median sales price grow slower and slower and slower in the dotted blue line until 2025, when condos actually decreased in price just barely and have since recovered. Meanwhile, the HOA fees at rolling monthly average have increased and increased and increased. And this is not just this is the change has increased, right? So they're increasing currently at a rate of 7.5%, right? They're still increasing. This is something that I think is capturing a lot of people's attention because we are now seeing fewer people buy condos than uh, single family homes in comparison. So, this is just an indicator of the impact of what these insurance premiums are having on the market. And we're isolating out condos because we can specifically see those HOA fees, which we know are they're proportional to master's insurance policies, right? Taking a step back, let's take a look at those insurance insights that I want to make sure you all are aware of. Um, so, what insurance challenges are catching buyers off guard? Um, I'm taking information from a local expert here who works on insurance. This is a little outside of my depth, but I want to at least share what I've learned with him for you all. The things to be aware of. Uh, Older or wood shake roofs, are probably the biggest concern, and that is centered around years that the uh, shingles are on the roof, right? The question often comes in, can I insure a 20-year plus roof? The answer is yes, they do have solutions, but there will be different rates because of it, right? Talk with the home insurance providers. That is the way you can help your clients with this. Prior claims is becoming more and more of a concern, and it is the rate of claims on particular houses, claims by seller or even a buyer from a prior residence, can limit different carrier options. And that has a big impact on what's catching people off guard. And then finally, outdated utility systems, particularly knob and tube wiring, again, over my head. But knob and tube wiring and outdated systems, these reduce the availability, but they do work with some carriers. Some insurances work with carriers that can accept these items, right? Finally, on insurance insights, what should you be aware of in today's insurance landscape? Not all carriers fit all homes. They often specialize in different home sizes, standard, middle market, high volume homes. A company offering a policy doesn't always mean it's the best match for your client. Keep that in mind. There, uh, there are many policies used for fix and flips or renovation projects that exclude crucial coverage, such as excluding any and all water damage coverage, something even experienced investors often overlook. So, those gaps in renovation coverage do end up being something that you should be aware of if that is your thing or your client's thing. Finally, here, policy understanding is rare. Many buyers admit they've never had someone clearly explain their coverage. Make sure your client is finding someone who can explain their insurance coverage for them, because that can lead to confusion or frustration down the line if they are not firmly understanding what is happening. Um, because I'm so new to collecting this data directly, I didn't put it here written because I want to be able to tell you and not just have it be in isolation of different charts. I do have numbers for Minnesota's average premiums right now, just for your context. Greater Minnesota overall, which includes the Twin Cities, there is an average of $3,700 dollars per year for insurance premiums. For Hennepin County, that is $4,200 a year. For Ramsey County, that is closer to $4,000 a year. Again, first time I'm seeing numbers like that, and I want to make sure that I really understand that before I make a whole graphic about it. But those are the first three numbers that I have ever gotten from this, so keep that in mind. Now, we don't have much time here. So I'm going to go a little bit faster here, talking through the rest of financing. We know generally financing methods are predominantly still conventional financing, making up about 70% of all homes sold so far here in 2025. But we know that mortgage rates um, have have been a little reluctant to move. Here were projections at the start of the year that most experts were saying we were dropping to the low sixes by the end of the year. Thanks to our friends at Keeping Current Matters who are paying attention to this for us. This was just in May. Those expectations have been pulled back a little bit more, right? We are seeing end of year expectations in the mid sixes. Some people are still holding. Wells Fargo is still expecting 6% average for a 30-year fixed rate mortgage. I I'm feeling a little bit more conservative, of probably somewhere where MBA and NAHB is, and you know, take this with the grain of salt because we know that there are political behaviors, there are other factors that are coming in that play into this all the time, right? Outside of conventional financing, we know that we are seeing cash sales market share increase. The rate of that increase really was from 2020 through 2024. Surprisingly enough, there's been a leveling of the percent of all sales that were financed with cash. So far, for the first half of 2025, it's about equal with where we were this time last year. No additional growth on top of it, right? Something really interesting, right? We're seeing that increase of cash sales. Um, we'll see if this ends up holding or if we see an increase towards the end of the year. In terms of cash sales by property type, this isn't just hitting luxury areas. This isn't just hitting the most affordable areas. In fact, you're seeing that general increase happening single family in blue, townhouse in orange, condos in gray. Obviously, that increase in condos, it's a smaller market and it's a smaller price point usually in general. So keep that in mind as well. The larger economy, with just a few minutes left here. Don't know, some of you may have heard there was a big tax bill that ended up being signed into law the first part of the month. I joke a little bit, it was on the news everywhere, right? And this has real world implications for your clients, bringing you back to 2017 with the concept of a state and local tax deduction. Prior to 2017, there was no cap on how much you could deduct from your federal income taxes in terms of state and local tax. Um, Generally defined as a range of taxes, such as like sales tax, property tax, income tax, right? Um, there was a cap placed on that in 2017 of $10,000. The bill that was passed earlier this month quadrupled that cap to $40,000 because the original $10,000 set in 2017 was a bit too strict. So that SALT deduction has benefits, but not benefits universally across different states because states tax differently. The chart that I have here for you shows us the redder the state in this context, the more higher taxed. Um, we're seventh as a most taxed state by this website's measurements. It's madisontrust.com. I have the link in the slides for you if you want to look at it in detail. But main takeaways here, Minnesota is about 12th, about 12th in sales tax, about 19th in property tax, and fourth in income tax. And the income tax portion is really where the potential benefit comes in when we talk about the state and local tax SALT deduction benefits for your clients. Because we're talking about a type of tax that primarily benefits high income earners. As we saw, Minnesota has a relatively high median family income and property owners. So you work with people who generally are going to fit the bill in those two categories, and that is a win for your clients, therefore a win for realtors. Again, following that good news, there are strong employment signals here in the Twin Cities metro. Our unemployment rate has been hovering around 2.5%, and that is pretty good. Again, making that earning of median family income that much more consistent here in the Twin Cities. Another indicator of good market conditions for us is a stable cost of living. We talked about this in the housing context, but generally, economically, we have had consumer price index, our inflation rate, go down from a height of 7% with the pandemic to now around 2.4%. But yet another thing that has been happening in the news that, again, you should all be aware of is we're all starting to ask ourselves the question, will US trade impact the housing market? And the jury is truly out on this one. Uh, Remember back to the first quarter of this year where there were these promises and expectations of, immediate and strict tariffs. And then we had a bad first quarter and from an economics and finance perspective, and then all those tariffs kind of disappeared overnight, right? And now we are seeing, this is data from just 2 weeks ago, we're seeing a return of more posturing around tariffs. Tariffs are one of those things from putting on my public affairs director hat now and not just my researcher hat. Um, the threat of tariffs are often more powerful than the tariffs themselves. It is as powerful as a negotiating tactic when you're talking about sovereign entities. And you can see we got a lot of sovereign entities here with our graph of largest trading partners that have a lot of push and pull with us. And to see a lot of the similar names, Mexico, Canada, Japan, South Korea, there's a lot here of threatened or, suggested or however the rhetoric you want to use, tariffs uh, up against our largest trading partners if they end up becoming both actualized, like real, and they're there long enough to have that trickle down effect of impacting the businesses in those countries and therefore them having to increase their prices and then pushing that price increase onto us, the consumer, then yes, we will see an impact in our production of homes in terms of labor, uh, lumber, more particularly. And that is the thing that I'm really paying attention to because all of this is noise until it impacts construction costs. Construction costs here, in terms of net inputs to residential constructions, like the goods, whether that be drywall, lumber, concrete, whatever it is, right, have increased and have kind of stayed pretty stable since July of 2022. And if all of a sudden they increase again, it might be because of the trade uh, conversation that we're talking about. Which is why you have been seeing, in terms of this is looking at the average percent of all inventory as new construction. We saw an increase in new construction inventory in 21, 22, 23, but then when the price leveled out, like we saw in the last chart, that increased cost to those goods have meant that it's less and less frequent that we are seeing inventory of new construction homes. So, final takeaway for you all here. Buyers, there's an ideal mix of supply and demand right now, at least with the conditions that we have. Um, the price to income ratio on average here, obviously, your client's own story may differ, but on average, it means that there is a certain level of attainability for home ownership here. And that return to historic price growth is already occurring at some times. We're going to see that become more of the regular norm. We're unlikely to see that rate of growth in new construction develop further. Yes, mortgage rates are high, but we're seeing that there's a potential that they might ease up in time. And don't miss out on that price softening that we were seeing, right? Sellers, the COVID economic correction is over for the most part. Let's knock on wood, right? Um, home prices barely dipped, and that is a good indicator of sustainability for you, right? The things you have to be mindful of are those political shifts that we just talked about, salt deduction, and mainly lumber costs, all construction goods, right? But lumber is a great way to kind of simplify it for your clients. If you are ready to make a remodel, keep in mind the added costs of lumber nowadays, plus the added costs of labor, right? Um, those are just from an economic lens, some things you should all be considering. I do want to take 5 minutes here and just show you the uh, tool that is on our market data webpage. I'm going to bring us back to the market data webpage here at the MAR website and show you a tool that is an exclusive member benefit. You are going to have to sign in here, one click to log into your member portal. Will it let me? There we go. Log into your member portal, and you will have what's available to you, a new interactive tool for you to show your clients as an exclusive member benefit. This is the same data that we just looked at from the North Star MLS. It's presented to you in a spatial way to make sure that you are able to share this in a more intuitive paradigm with your clients. Real simple stuff here, right? Let's kind of zoom in here and make it real big for everybody. You have by default median days on market for our latest month, and you can hover over any area here and you can get a breakdown of the median days on market and how many closed sales there are in any given area. Plymouth, Eden Prairie. Oh, look over here, Eden Prairie Township. Oh, that's got a median days on market of 8, which is really high, but only 2 closed sales. Enter in our little filter down here at the bottom because we know that a single home that sells in a really rural area and it's the only home that sold that month isn't the best indicator for the hottest market in the world, right? So we enter in, let's say, a minimum value of 10. You can pick your own threshold here. And now you're only looking at cities that sold 10 or more properties in June. And you can now look at an area like Deep Haven that has median days on market of 4, or maybe Medina, median days on market of 7, or even North Oaks, a median days on market of 40. That gives you an indicator of those hot areas. It's not just for median days on market, but we also have month supply of inventory as well. So you're looking at that comparative advantage between buyer and seller, where it looks like Ham Lake is a balanced market right now, where Richfield is very much a seller's market. We also have median sales price, just a great way to visualize the areas with higher dollar volume and more affordable dollar volume in the Twin Cities, as well as just straight up, hey, where are the homes being sold? Uh, we have 127 listings in Woodbury versus only 13 in Mounds View. And if you really want to dive into one area in particular, you can take a look at just Hennepin County. And hey, look, we're just looking at the Hennepin County area. I hope you see this tool as helpful. I sure do. This is one of our favorite things that we have been able to build for members for the past couple months, and it's a free member benefit for you. Please use it. Engage with us. Let us know if we need to make any updates to it. If there's something new that you want to have added. We're gonna play around with different geographies as well. So please, reach out. My email is right there. That's a shared email between both myself and our research analyst, Gavin. Happy to answer any questions that you have in the comments if you're joining here on YouTube. But I am going to end the recording now to answer any questions from our live audience. All right. Thank you all very much. We will see you next time.